The focus today shifts squarely to the release of the FOMC minutes, with markets looking for greater clarity around how concerned Federal Reserve officials have become about persistent inflation pressures and elevated geopolitical risk. Expectations are that the minutes will reinforce the message from the April meeting that policymakers remain increasingly uneasy with inflation staying above target, particularly against the backdrop of resilient growth, firm labor markets, and rising energy prices tied to the Iran Hormuz situation. Investors will be paying especially close attention to how seriously Fed officials discuss the possibility of additional rate hikes. While the Fed stopped short of formally adopting a tightening bias at the last meeting, several policymakers reportedly pushed back against language that still implied an easing inclination. Since then, markets have steadily repriced the possibility that the next move from the Fed could ultimately be a hike rather than a cut, marking a notable shift in the broader policy narrative. The inflation backdrop has only added to those concerns. Oil prices remain elevated among ongoing disruption risks around the Strait of Hormuz, while broader inflation measures continue to run well above the Fed's long-term target. At the same time, the U.S. labor market has remained resilient, reducing pressure on policymakers to move toward easing financial conditions anytime soon. From a market standpoint, a hawkish interpretation of the minutes could reinforce the recent rise in Treasury yields and provide additional support for the U.S. dollar while weighing on equities and other risk-sensitive assets. Growth sectors remain especially vulnerable to higher real yields, while FX markets will continue reacting closely to shifting rate expectations and global sentiment. That said, markets have already repriced meaningfully in a hawkish direction in recent weeks, suggesting the hurdle for an additional hawkish shock from today's minutes may be relatively high. Unless the minutes materially exceed current expectations, there may be room for some stabilization in equities and broader risk sentiment if investors come away feeling the release largely validates what is already priced into the market. That's all for now.